How is it mathematically possible for a company to post some of the most spectacular, expectation-shattering financial numbers in corporate history and then lose $260 billion in market value the very next day?
That sounds made up.
It really does. But welcome to today's deep dive. We are unpacking exactly that incredible paradox today, focusing on Nvidia's Q4 fiscal 2026 earnings report.
Right, the one that broke the internet.
Exactly. And to really understand what happened here, we've pulled together a massive stack of sources. We're looking at expert commentary from NASDAQ, The Motley Fool, UBS, and various market analysts.
A lot of dense material.
It is very dense. But our mission today is to explore the jaw-dropping numbers from this report, look at the futuristic tech that's actually driving them, and decode why the stock market reacted with a massive historic sell-off.
Yeah.
I promise we are going to cut through all the heavy financial jargon so you can understand exactly what this means for the future of the tech industry and, potentially your own portfolio.
And it really is the ultimate financial paradox. Because what's fascinating here is that this isn't just a story about microchips or graphics cards anymore.
No, not at all.
It's a story about a fundamental transition in the broader market. We are watching a shift from an era of growth at any cost to a new era demanding growth durability.
Mirth durability, I like.
Yeah, we are looking at how one single company has essentially become the undisputed load-bearing engine of the modern stock market. And we really need to examine what happens to everyone else when that engine starts running so hot that investors get nervous.
So let's start with the what? The numbers that had everyone's jaws just on the floor.
The triple beat.
Right. Analysts were calling this a triple beat, which for you listening means they exceeded expectations across the board, top to bottom.
In a major way.
Yeah. The company reported a Q4 revenue of $68.1 billion.
Wow.
Which is up 73% year over year. And for the full fiscal year of 2026, their revenue reached an astonishing $215.9 billion.
It's just a mountain of cash.
And if that wasn't enough, their revenue guidance, basically what they project they will make in the first quarter of fiscal 2027, was set at $78 billion.
Right.
That completely smashed Wall Street's expectation of $72.6 billion. They didn't just clear the bar, they launched it into orbit.
They absolutely did.
But numbers that big can be hard to wrap your head around. Where is all of this money actually coming from?
Well, to understand the sheer scale of the revenue, you have to look at the internal breakdown of their business units. The money is flowing almost entirely from their data center segment.
Okay.
That specific unit generated $62.3 billion in the fourth quarter alone.
Just the fourth quarter.
Just Q4. And to put the company's transformation into perspective, data centers now make up 91% of their total sales.
91%.
Yeah. The historical context makes this even more staggering. That specific data center business has scaled an incredible 13 times since ChatGPT first emerged and kicked off the generative AI boom back in 2023.
13 times in just a few years.
Exactly. They have successfully transitioned from being known primarily as a gaming-focused chipmaker into the absolute dominant supplier of global AI infrastructure. They are quite literally building the factories of the new industrial revolution.
And the cash they're throwing off from these factories is mind-boggling. According to the reports, they generated $97 billion in free cash flow for the year.
Which is almost unheard of.
It is. That is so much extra cash sitting around that they spent $40.6 billion just buying back their own stock.
Right.
And I want to pause on that for you listening, because stock buybacks are a huge indicator of corporate health.
Absolutely.
It's when a company uses its cash to buy its own shares off the open market and retire them. It reduces the total number of shares out there, which makes every remaining share more valuable.
It's rewarding the shareholders directly.
Yeah, between those buybacks and cash dividends, they returned $41.1 billion to shareholders. It's an absolute flex of financial power.
A massive flex.
But then, we look at how the market is valuing all of this.
Right.
Right now, Nvidia is trading at a forward price-to-earnings ratio, or PE ratio, of roughly 47 times.
And the PE ratio is the metric that tells the real story of the market's expectations. For you listening, think of a PE ratio as the price you are paying today for $1 of the company's future profit.
Okay.
So a forward PE of 47 means investors are willing to pay $47 today for every $1 single dollar of profit the company is expected to make next year.
Wow.
And here is the kicker. The average forward PE for the S&P 500 is roughly 22 times.
22 compared to 47.
Right. The market is pricing this company at a massive premium compared to the rest of the economy.
Okay, let's unpack this. What does it actually mean when financial analysts look at a 47 times PE ratio and say a stock is priced to perfection?
Well, being priced to perfection means the market has already factored years and years of flawless, uninterrupted, exponential growth right into the current stock price.
They're assuming nothing goes wrong.
Exactly. It assumes there will be no supply chain hiccups, no drop in customer demand, and no successful competitors for the foreseeable future.
That's a tall order.
It is. When a stock is priced that high, simply beating analyst expectations isn't enough. You have to obliterate those expectations, and you have to prove that there are absolutely no speed bumps on the horizon.
Right.
If there is even a hint of a slowdown or a shadow of a doubt about future demand, the stock price becomes incredibly vulnerable because there's simply no margin for error built into that valuation.
Which brings us perfectly to the technology driving all of this demand. Because they have to keep innovating at breakneck speed to justify that premium.
They do.
In the earnings release, CEO Jensen Huang made a massive statement. He said, and I quote, "The agentic AI inflection point has arrived."
Yeah, that was a key moment.
We hear the term AI constantly, but what does he actually mean by agentic AI?
The distinction between traditional AI and agentic AI is really crucial for understanding their future growth. For the past couple of years, the massive spending in the tech sector was all about training AI models.
Right.
That meant feeding them mountains of data so they could learn patterns. Think of it as sending the AI to school.
But
What Huang is signaling is that we are moving past that training phase and into the inference phase. Inference is when the AI is actively running, reasoning, and executing tasks in the real world.
And that's the agentic part.
That is where agentic comes in. Agentic AI refers to systems acting as independent agents. Instead of you typing a prompt into a chatbot and getting a text response, an AI agent can book a flight, manage a global supply chain, or write and test its own code without needing constant human supervision.
So training is the AI studying for the test, and inference is the AI actually going out and doing the job.
That captures it perfectly. And the reports also highlight a massive surge in what they call physical AI.
Physical AI?
Yeah. This category includes things like the computing power behind robotaxis from Waymo and Tesla, as well as the brains for humanoid robotics. The data shows that physical AI alone added over $6 billion in revenue to their books this year.
Now, I saw some wild names in the research notes regarding the hardware required to run all of this. Names like Blackwell, Rubin, and Vera.
The new architecture.
Right. And I also saw a terrifying statistic about their current tech powering nearly 9 gigawatts of AI infrastructure globally. 9 gigawatts.
It's massive power consumption.
What exactly are they building next to keep this monopoly alive?
Well, the rapid innovation cycle you're seeing in those notes is entirely necessary because of the sheer computational demands of agentic AI. The Blackwell systems are their current generation, which are deploying globally right now.
Okay.
But the sheer volume of data required for AI agents to reason in real time is pushing the absolute limits of physics.
Yeah.
So they're already shipping samples of their next generation platform called Rubin, yes, alongside a new central processing unit called Vera. And the Rubin platform promises a 10 times reduction in inference token costs compared to Blackwell.
A 10 times reduction in cost. That sounds like a game changer for businesses trying to actually use this stuff.
It is the key to mainstream adoption. That cost reduction is critical for making AI agents economically viable for everyday enterprise use.
Because right now it's super expensive.
Very expensive. As for the Vera CPU, the issue the industry is facing is that traditional central processing units have actually become a bottleneck.
Really?
Yeah. The graphics processing units, the GPUs, are so fast that the rest of the computer can't feed them data quickly enough. Vera is designed specifically to handle heavy AI data, ensuring the entire system stays incredibly fast.
That makes sense.
As Jensen Huang succinctly put it in the call, compute equals revenues. If a cloud provider can't process the AI tokens fast enough, they simply can't generate the revenue.
Here's where it gets really interesting. With all of these perfect numbers, the revolutionary shift to agentic AI, the $40 billion in stock buybacks, and the massive revenue guidance, you'd think the stock would soar.
You would.
But the day after they reported these earnings, Nvidia's stock plummeted 5.5%. That erased roughly $260 billion in market value in a single trading session.
A historic drop.
For context, for you listening, $260 billion is like wiping the entire value of a major Fortune 50 company like a Netflix or a PepsiCo completely off the map between breakfast and lunch.
Poof, gone.
Why did Wall Street panic over a perfect report?
The panic stems directly from that price-to-perfection vulnerability we discussed earlier, combined with a growing fear on Wall Street known as the ROI gap.
Return on investment.
Exactly. The major buyers of these chips are the hyperscalers.
Let me jump in really quickly for everyone listening. When we use the term hyperscalers in this context, we're basically talking about the massive cloud computing giants, right? The Amazons, Googles, Metas, and Microsofts of the world. The company's operating server farms the size of small cities.
Those are the exact players. These hyperscalers are currently spending nearly 100% of their free cash flow buying hardware to build out massive AI data centers.
Wow.
They are pouring billions upon billions of dollars into infrastructure. And the ROI gap refers to the growing anxiety among investors who are starting to ask the hard questions.
Like, when do we get paid?
Precisely. When is all of this massive capital expenditure going to translate into proportionate software profits? Microsoft and Meta are buying the chips, but are their customers paying enough for AI subscriptions to justify the cost?
So if I'm understanding this, Wall Street isn't necessarily worried about Nvidia's ability to make the chips. They're worried that the people buying the chips might suddenly slow down their orders if their own AI software doesn't start making serious money.
That is the core issue. It's a fear about the velocity of spending. If Wall Street decides that the hyperscalers are overspending without seeing a return, shareholders will pressure those tech giants to scale back their capital expenditures.
Well, that would be bad.
Very bad. And that exposes the biggest vulnerability in the earnings report. During the call, a shocking statistic was revealed. Just 2 major customers account for 36% of total revenue.
36% of a $215 billion pie coming from just 2 companies.
Yes.
That is a massive concentration of risk. If even one of those hyperscalers decides to trim their budget by 10%, the ripple effect on the revenue stream would be catastrophic.
The concentration of revenue is a massive red flag for risk analysts. And looking at the data, it wasn't the only concern the market decided to focus on that day.
What else do they see?
Well, while the data center revenue was explosive, their gaming revenue, which used to be the foundational core of the company, came in at $3.7 billion. That actually missed analyst estimates of $4 billion, primarily due to a post-holiday inventory lull.
We also need to talk about the geopolitical headwinds mentioned in the sources. The China export restrictions seem like a hard structural barrier. The Q1 guidance explicitly assumed absolutely zero data center compute revenue from China.
Yeah, the geopolitical landscape has fundamentally altered their total addressable market. Losing the Chinese market, which was historically a massive consumer of tech infrastructure, is a significant blow.
Right.
The company is actively trying to fill that revenue gap with what they call sovereign AI deals.
Sovereign AI. That's when entire countries, rather than individual companies, buy up infrastructure to build their own national AI networks, right?
Yes. They are securing massive contracts with governments in places like the Middle East and India to build localized AI clouds. But replacing the sheer volume of the Chinese tech sector is a monumental task.
I can imagine.
Furthermore, the sources highlight rising competition. This isn't just coming from traditional rivals like AMD. The hyperscalers themselves, specifically Google and Broadcom, who are aggressively developing custom chip programs.
Making their own.
Exactly. Over time, these in-house custom chips threaten to reduce the heavy dependency on off-the-shelf GPUs. Wall Street is aggregating all of these factors, the ROI gap, the reliance on 2 massive customers, the loss of China, and the rise of custom chips, and deciding that the risk profile has fundamentally shifted.
So what does this all mean for the everyday investor? You might be listening to this thinking, well, I don't own individual tech stocks, so why should I care if one company drops 5%?
Yeah.
But the sources make it crystal clear that you really should care.
You absolutely should, because if we connect this to the bigger picture, the influence this single entity has on the broader market is entirely gravitational.
Gravitational.
Yeah, by early 2026, the data shows this one company accounts for roughly 8% of the entire S&P 500 index.
8%. One company.
One company. And this is crucial for anyone with a 401k or a standard retirement account. Most retirement accounts rely on market cap weighted index funds.
Right.
In a market cap weighted fund, the bigger the company, the more of your money is invested in it. Because it holds such a massive weight, its individual performance dictates the overall market's performance.
So as they go, the market goes.
Exactly. On the day of that 5.5% drop, that single stock was responsible for 80% of the S&P 500's total point loss.
That was staggering.
Hmm.
One company essentially holding the entire stock market on its shoulders. If they stumble, everyone's retirement portfolio takes a hit. And that really paints a picture for these 2026 projections, doesn't it?
It does. It represents a systemic risk factor for 2026 and beyond. The analysts in our sources are tracking how this feeds into a broader narrative of AI fatigue.
AI fatigue.
If you look at historical precedents, we can compare the current market anxiety to the year 2000 dot-com bubble or the Nifty 50 era of the 1960s and 70s.
Okay, I know the dot-com bubble.
Right, during those periods, even the most dominant paradigm-shifting companies eventually faced a show-me phase.
The show-me phase. That's the moment when the hype fades and investors demand to see the actual math working out.
The market stops rewarding the promise of a utopian future and demands cold, hard economic viability today. Valuations outpace the immediate, real-world utility of the technology.
It's like building the world's most advanced, expensive railroad. For the first few years, the companies laying the tracks and selling the steel make an absolute fortune.
Exactly.
Everyone is excited about the railroad. But eventually, investors want to see the actual trains carrying actual cargo that everyday people are paying for.
Right.
If a cargo doesn't show up, or if people aren't buying tickets, the people laying the tracks are suddenly in a lot of trouble.
The railroad analogy captures the infrastructure build-out perfectly. Because this one railroad company makes up 8% of the S&P 500, policymakers and regulators are actually getting nervous.
I would be too.
The sources mention renewed calls to rebalance major financial benchmarks.
Rebalance them.
Yeah, the goal of rebalancing would be to cap the influence of any single mega-cap stock, protecting the broader market from a tech-led systemic correction.
So to bring it all together for you listening, we are looking at a company successfully building the hardware factories of the AI industrial revolution.
Undeniably.
They're fundamentally changing how computing works, shifting us from merely training models to actively running agentic AI in the real world. They're generating mountains of cash, enough to casually buy back $40 billion of their own stock.
Right.
And their projections for 2026 and early 2027 show them continuing to grow at an unprecedented scale. Yet, Wall Street is slamming on the brakes. They're looking at that massive forward PE ratio, comparing it to the S&P 500 average, and demanding proof that the hyperscalers buying this incredible hardware can actually turn a profit from the end users.
And this raises an important question for the long term, and it points to a detail in the sources we haven't fully explored yet.
What's that?
Right now, the market treats them almost exclusively as a hardware titan. Because of that, they are highly vulnerable to the spending moods of just a few massive tech companies.
Right, the two customers making up 36% of revenue.
Exactly. But if you look closely at the research notes, they are quietly building a massive software ecosystem alongside the hardware.
Oh, interesting.
They have platforms like Omniverse, which is used for creating digital twins of physical factories, and AI Foundations, which helps companies build custom models.
I noticed those names in the notes. So they aren't just selling the physical chips. They are building the operating systems and the software environments that developers have to use to interact with those chips.
They are creating a closed loop. Developers learn to build on their software, which only runs optimally on their hardware.
That is incredibly smart.
So here is something for you to mull over as we wrap up. If the physical AI data center build-out eventually slows down, as all infrastructure projects eventually do.
For railroads.
Exactly, like the railroads. Could their ultimate unshakable monopoly actually turn out to be the software ecosystem they are quietly embedding into the enterprise world?
Wow.
To maintain their astronomical valuation and survive the show-me phase, will the hardware giant of the 2020s need to become the software giant of the 2030s?
That is a fascinating thought to leave on. A potential transition from making all your money selling the engine to making your money selling the ongoing subscription required to drive the car.
Exactly.
We want to thank you for joining us on this deep dive into the numbers and the narratives shaping the tech world. As we move through 2026, keep a very close eye on the capital expenditure numbers coming from the tech giants in the coming months. If their spending on AI infrastructure shows even a hint of slowing down, the aftershocks will be felt far beyond a single boardroom. Until next time, stay curious.